Okay. Hey everybody, welcome to the webinar on OBIT Trust with Ryan Fowler. And
Hello.
we want to get right to the disclaimer, Ryan. We are not attorneys, neither Ryan nor I, although Ryan works very, very closely with attorneys who understand all of the stuff we're going to be talking about today. The reason some of you are on this call is because you're CPAs, tax planners, EAs, financial advisors, agents, brokers, or you're entrepreneurs and business owners, and you're concerned about capital gains tax and the changes to that tax, and you want to avoid as much tax as possible. The reason I do this is that I am a person who believes that any way that is legal, moral, and ethical that you can save money on taxes, you should be doing it. You owe it to society. So that's my personal belief. So there's quite a few of you who are in here in that situation that you're facing a capital gains tax. With that said, we want to let you know that this webinar and all associated content, emails, and everything like that concerns information about legal and financial matters. It's for educational and entertainment purposes only. It's not advice and should not be construed as such. Trust me, you don't want to take advice from me because I don't know anything. The legal information on this webinar is provided as is without any representations or warranties expressed or implied. The information on this webinar is not an alternative to legal advice from your attorney or your financial advisor or your broker or your tax person, okay, or any other professional legal services provider. If you have specific questions, you can, of course, contact Ryan, but you should also consult your own personal, professional, or legal services provider, okay? You understand that? So we're not attorneys, but that being said, we're going to give you a lot of cool stuff. So be prepared to write things down right now. The first thing, some of you were directed to this when you registered. Others of you came on late. So I want to give you the URL to get a free Udemy workshop. If you're a math nerd especially, or you like investing using data, you're going to love this. It's tinyurl.com/real focus. So that's tinyurl.com/real focus. Couple of upcoming events for those of you, some of you indicated to me through email and other means that you are into the real estate sphere, you like real estate investing, and why not? It's the greatest wealth builder in America, I think, except doing fake IPOs for companies that'll never make a profit. But anyway, free online training, learn how to build wealth with 1031 exchanges. It's on Monday, April 22nd. You will see how to register right there. Absolutely free with a couple of experts in the 1031 exchange sphere. Also, again, on the 25th, this is those of you who are passive investors or you're interested in multifamily investing or syndication. Gonna love this one with Dugan Kelly. It's at 6 p.m. on April 25th. Okay, so there's the URLs, and you're gonna get a copy of this recording. So if you didn't have time to write them down, that's fine. I want to give a special thanks to Teresa Kuhn and the late Nelson Nash. I've had the privilege of being a friend and colleague of Teresa for over 10 years now. She is, as I said, one of my favorite people on the planet, and she introduced me to Nelson several years ago, changed my life, and I'm sure many of you are really familiar with Nelson Nash. God bless. He passed away a couple of weeks ago, but his legacy lives on forever. And with that, ladies and gentlemen, this is Tammy DeLu here, and my special guest today is W. Ryan Fowler. The W is for wise, because this guy, he looks young. He looks young.
That's a 10-year-old photo, by the way.
Yeah, he's still young. Okay, he's still
I'm 45
young.
now.
Yeah, that's baby. I got socks older than you. Okay,
all right.
So he's still young, but he knows a lot about this stuff. As a matter of fact, I have an attorney friend in Orange County who told me that he thought Ryan had much more knowledge than a typical attorney when it comes to trusts. He's done several trusts with Teresa's clients. He's done trusts for some of my own personal friends. He is really specialized with this. And he wrote a book a few years ago with the late Arnold Goldstein called Asset Protection in Financially Unsafe Times. Guess what? When you stay on this call, you're also going to get, in addition to Ryan's article, you're going to get a PDF, an electronic version of this book. And even though some of the things need to be updated, Ryan, it still has a lot of good information about the philosophy of asset protection. And I'm all about asset protection. Ryan, if I had any assets, you'd be protecting them, dude. So without further ado, Ryan, I just want you to, first of all, give a 1-minute overview of who you are, why you do this, and then we'll get right into the meat of this whole thing.
Okay, thank you very much, Tammy. So like Tammy said, I'm Ryan Fowler. I've been doing asset protection and estate planning for 16 years. In addition to that book, which I wrote with Dr. Goldstein, came out in 2009. I have probably about 150 pages of more up-to-date writing. So with regards to this strategy or just asset protection and estate planning in general, I freely share these writings. Most of them are, footnotes or endnotes referring to court cases, case law. That book I wrote with Dr. Goldstein, over 400 endnotes. So I back up everything I do with, case law, statute law, regulations as needed. All of this planning is always done under attorney supervision. I have a network of attorneys that I work with. With that said, they're the ones referring business to me. They understand that, I'm the one that really dives deep on this. So if you find after this presentation you would like more information, I can happily send you as much information to your heart's content, showing the legal basis and the ands, ifs, or buts on this type of planning. I tried to make this the information in this presentation as simple as possible while still covering all the main points. With that said, it's still somewhat technical. I try and keep it less technical, but there are some things that you absolutely have to know that we're going to cover in this. And if you want to dive deeper, just let me know. I'll get you the deeper research that can get pretty technical, but I'm happy to do that and give you as much or as little information as you want. So I got my start doing, I had a business fail 18 years ago, and I learned the hard way about the need for asset protection. And so I started out with asset protection and then estate planning, which asset protection is, taking your wealth off the table so that if you later have creditor issues, those assets are not available to your creditors. Last minute planning before you get sued, it can be risky. So you always want to do that type of planning when seas are calm, creditor seas are calm. But a big component of asset protection estate planning is trusts. And as I learned more and more and did more and more research about trusts, I ran into some attorneys and CPAs that pushed me very hard to learn some very esoteric things that also my clients had a real need for. And about 4 years ago, a CPA I was working with, we came across a very technical article by a very high-end attorney that talked about optimal basis increase trusts. And this is a very niche field in estate planning. I'm not exaggerating when I say if you are the right type of person for this trust, it will probably be the best tax savings strategy you ever come across. I'm going to cover some case studies in just a little bit that I think will floor some of you, if not all of you. There can be some very, very big tax savings for this type of planning. And that's in addition to using a trust for basis optimization or basis step up. It always has robust estate planning and robust asset protection as a component. We always look at things holistically and try and get you as many benefits with these trusts from as many angles as possible. So OBITs, optimal basis increase trusts, they're not for everyone. It's a high-end sophisticated niche tool. If you do a search on Google, you will see a few very high-end attorneys who have articles on this type of planning, but it is niche. It's catching on more and more. The reason that it's catching on more and more is you can step up assets And for those of you who don't know what basis or what step up is, I'm going to cover that on the very next slide. But you can do this up to your estate tax exemption amount. What that means is right now, if you died and your net worth was under 11.4 million, you paid no estate tax. To the extent it's over that, you pay a 40% estate tax. And so the amount of assets that can benefit from this strategy are limited because of how the law is written, is limited by that exemption amount. Now, the estate tax exemption used to be much lower. You go back into the 90s, if your wealth was over 600,000, then you'd start paying estate taxes. So, and even you know, in 2000, I believe in 11 and 12, even you know, 7-8 years ago, the estate tax exemption was 1/3 it was now. Because of the Trump tax plan, the estate tax exemption doubled, which means this particular plan has become supercharged for the amount of tax savings you can get. So this is, you know, mostly for, this really is a plan for high net worth individuals. But for example, in California and some other states, if you own one property, you could be a high net worth individual, even if it's $1 million property and you owe 800,000 on it and you have 200,000 equity. If it's an appreciated property, you may still want to do this because you could still save 6 figures in taxes. So I guess that's a relative term, high net worth. But the type of people that this is good for is if you have income producing real estate, thank you, Tammy, especially in a pretty much any state in the nation, but especially a state like California that has very high state capital gains. You're going to want to take a good look at this strategy. A lot of people have operating businesses that have a lot of capital. Farmers, for example, I do planning for farmers, and they tend to have a lot of equipment that they depreciate. Well, with this strategy, they can depreciate their assets in 1 to 7 years, and then there's a triggering event with that allows us to redepreciate that property all over again. I had one farmer last year I saved 2.8 million on. So, but it could be really any operating business with capital. We cannot step up assets or get the tax savings for corporations, but if you have an LLC or a partnership, if the LLC is not specifically taxed like a corporation, by default it's not, then this will work very well. If you have stocks that are highly appreciated that you've held on to for a while, this will work well. Any type of highly appreciated assets or assets that you take a depreciation tax deduction on or that produce income, this planning works fabulous for. This planning does require a elderly close friend or relative to pass away, and when they pass away, you can step up sometimes 11 million, sometimes more of property upon their death. So if someone comes to me and they don't have any close friends or relatives that they expect to pass away, say in the next 10 or 15 years, then this, you know, of course, won't be as beneficial. That the passing of an elderly relative or close friend is the triggering event. We'll talk a little bit shortly about ideal persons, but just moving on now, let's talk about basis. What basis is it's tied to capital gains tax. And when you sell a property, your capital gains tax is computed on the difference of the basis in your property and what you sell it for. Now, if you don't take any deductions, depreciation deductions, then that difference is going to be what you paid for the property, the cost basis, and
Hello, Ryan, I cannot hear you anymore.
so if you bought a property for 200,000 and you sold it for, can you hear me?
Yeah, okay,
hello?
We're back. You're back again.
Hello?
Hello,
Okay.
You're back again.
All right, thank you. Okay, you hear me fine? Hello?
Yes. Yes, you're fine. Go
Okay,
ahead.
thank you. Okay, so basis, it's used to calculate capital gains tax. Now, your basis, when you sell a large asset, your capital gains tax federally can be up as high as 23.8%. And if you're selling an asset for a few $100,000 of taxable gain, you're going to be at that tax rate. And then there are some exceptions where that tax rate can be even higher. And then if there's any state capital gains, then that will be on top of your federal rate. So for example, in California, you can pay a state tax, California tax 13.3%, 23.8 federal, you're at 37%. The whole point of this strategy is it wipes out that tax liability when an elderly relative passes away. And I am giving the 50,000 foot view, but in almost all instances, you'll either eliminate the tax liability or at least greatly reduce it. So this is not tax deferral, this is tax elimination, which is the best type of tax planning you can do, of course. So just one final thing is if you have assets such as rental real estate that you take an annual depreciation deduction on, that reduces your basis. So if you ever sell that property, the capital gains is not only the difference between what you bought the property for and what you sell it for, but you also have to include the deductions you took, which increases your capital gains tax further. So in this example, let's say you bought a $2 million apartment building. 1.5 of that is the building. That's the part you can depreciate. You cannot depreciate land. After 10 years, you've taken about $518,000 in depreciation deductions. So that reduces your basis from 2 million to a little under 1.5. So then if you sell for 3 million, you're going to look at the difference between its basis, which is its cost minus depreciation, 1.58 million in taxable gain. That's $563,000 tax liability. So if you put that asset in a properly structured optimal basis increased trust, and then an elderly relative or close friend passed away, and then you sold the property, all that tax liability would be wiped out. But there's another type of tax benefit that some will find even better, which is that the triggering event when that person passes away will reset the basis in this property to its fair market value, and it resets your depreciation schedule. Go ahead and go to the next slide, Tammy. And so we're going to look at some case studies to illustrate this. I have two. And this is slightly tweaked from what I've done for actual clients. I can't give the exact same fact pattern because I don't want them to see it and get mad. But this is both these case studies are somewhat based on what I've actually done for clients. So I had a California client had a rental real estate in their name 29 years. And you can get a depreciation deduction each year for 27 and a half years. And then so that offsets the rental income. I think they're depreciating maybe 20,000 a year, 15,000 a year. The amount you can depreciate on rental real estate or equipment for a business, it's based on your basis. So they got maybe 15,000 a year deduction because they bought this property for 500,000 29 years ago. The total value 29 years later was 8.5 million. And they could no longer take any depreciation deductions, and in any event, they were only depreciating less than 500,000, about 500,000. So they wanted to sell this property, but they would have, at the 37% state and federal capital gains tax rate, they would have over 3.15 million tax liability. Well, we put this property into a type of OBIT. It's called a UOB-BEAT. And they had an elderly relative, their mother. She died a month after they put it into the trust. And they sold the property 3 months later with no tax due legally. And I'll get into the statutes in a
Wait a
bit,
minute.
but they
Whoa,
just
whoa.
saved $3 million.
Zero tax. And this is actual case. I just wanted to bring that to
Yeah, they
everybody's
just
attention,
sold this
Ryan.
property. This was a
It's
recent
amazing.
client.
Yeah, it's amazing. Yeah, I'm sure they were happy.
You should have seen the gift basket they sent me for Christmas. They sent me like the biggest, craziest. I gained 5 pounds on that single gift basket,
They
and I'm
should have
not
sent
kidding.
you more than they should have sent you more than a gift basket. They should have sent you a whole, a carload of dancing girls too.
Yeah,
But
you're
anyway,
right.
okay.
You're right. So, yeah, so zero tax liability. They just closed on that and sold it, and no tax. And their CPA signed off on it. I did that with an attorney, and I had a CPA on my end. Everyone signed off on it. It was legitimate under the law. Now, here's the kicker. I said there's 2 ways you get tax savings, because some people may be thinking right now, well, what if I have property and I don't want to sell it? Well, if you have income producing property, such as rental real estate, once the triggering event, the passing away of a close friend or elderly relative, once that happens, you realize tax savings for income producing property, even if you don't sell that property. Because what this does, when you get this triggering event causes a basis in the property to step up to fair market value, what it was worth at the time of that person's passing. So if you have a rental property, in this example, its original basis of 500,000, the amount you can depreciate is depending on the basis. So if that basis goes up to 8.5 million, you now have a brand new depreciation schedule, as if you had just newly acquired this building or this land and building at 8.5 million. So based on the building value, because you cannot depreciate the land, only the building, they would be able to have a depreciation of 225,000 a year for the next 27 and a half years. That offsets income. So you have 225,000 of income a year zeroed out for the next 27 and a half years in this instance, even if they did not
Wow.
sell the property.
Wow.
So how would you like that?
Well, I'd love to even be making that, but anyway, yeah, I'd love it, and everybody should really pay attention to that
Now,
portion of it.
of course, maybe you only have $1 million property or $2 million property. Maybe you don't have an 8.5. Well, in such an instance, your depreciation deductions won't be as high. But if you had a property you acquired, say for 500,000, and then that residential real estate, and it's now worth $1 million when the elderly person dies, well, your annual depreciation deductions effectively double, and the schedule is reset. So if you were 15 years or 10 years into your depreciation schedule, after 27 and a half years, you can no longer take a deduction. Well, this resets it to square one, and you can now depreciate for another 27 and a half years. So it not only can increase your deductions, but extend the amount of time. So let's go to case study number 2. And there was a Utah farmer, and he had farm equipment depreciated over 7 years. Some farm equipment you can depreciate up to $1 million per year immediately, and then some you depreciate over 7 years. But within 7 years, he had farm equipment that was all or mostly depreciated. This example is a little simplified, but that's more or less the case. And same situation, we set up one of these types of trusts, and the farmer's father died 1 year later. Well, these $7 million in assets they were actually worth, I don't know, 10 or 12 million, but they were worth 7 million at the time of the father's death. So they had been fully depreciated. He couldn't take no more annual deductions to offset income. When the father died, they get a step up. The equipment got a step up to fair market value, 7 million, and he was allowed to depreciate that over 7 years. So he got $1 million in annual deductions a year for 7 years. And it wasn't quite 3 million. I think it's around. It was in the high 2 millions that he was able to do that. So he was able to depreciate the same asset twice legally with this trust. Now here's another kicker. He had about 6 million in appreciated real estate with a $3 million mortgage. The amount of property that we can step up is about 11 million net. If the person who passes away is a wealthy, that amount will be lower because it's limited by what's their estate tax exemption. But 11 million net. So even though the total property was worth 13 million, because the net value was under the 11, you step it all up. So for example, if you had $30 million worth of property, but it's heavily encumbered and you only have 10 million net, that's going to be under the 11 million threshold and you'll step up all 30. So the amount you step up is based on the net value. If your net value is 10 and the gross is 30, you step up all 30 or 40 or 50. So there are instances where you can step up much more than 11 million. Again, if you have 2 million in property that's highly appreciated, or even $1 million that's highly appreciated, it's likely worthwhile to do this. But for those that are wealthier, it's really, really, really worthwhile
Hey,
to
Ryan,
take a hard look at this strategy.
do we have
Yes.
time? It's a good place to pause and get some of these questions answered. So what do you think? Would you like to
Sure.
answer a couple of questions?
Yeah.
Okay. Are one is are OBIT and UBO trust the same? What's the terminology there? The
Okay.
differentiation.
Yeah. So OBIT is a broad term, and then there's some kind of more narrowly defined terms. An OBIT trust, optimal basis increase trust, is any kind of trust that when a certain individual given a certain power and that trust passes away, it'll step up trust basis. Now, there's actually a few different types of trust we use that are OBITs, that's the broad term, but because they're different one from another, we'll have narrower terms to describe them. So we're actually talking about a subset of OBIT trust, which is called upstream beneficiary optimization trust.
Ooh, I love it when you talk technical. Okay,
Yeah,
so it's a more refined terminology, Byron. Just that's what it is.
yeah, and we're actually talking about when an upstream beneficiary, meaning an elderly relative, passes away, the assets you put into the trust get stepped up. So you realize tax savings for your assets you put in trust when an elderly relative passes away.
Right,
And it's
and
actually,
they get a gift basket for doing that. No.
yeah. Well, we can make this so there's no drawback whatsoever to the elderly beneficiary, and there's actually can be some benefit for them too, which we'll go into.
Okay. Here's another question. This is a good one,
Okay.
Ryan. This one's from Fred. If I have accumulated some large gains in a variable annuity, distributions are taxed as ordinary income. Are there any strategies that will give a step up in basis when the annuity is inherited after my death?
Yeah, I don't believe so. We can check, but I don't believe we can step up anything in an annuity. And I know for a fact that, by the way, IRA, 401k assets and that, the issue is you're not realizing capital gains. You're getting ordinary income. So you technically don't have cap now. I have to give a disclaimer. When I set up these types of trust, I always work with the CPA. I'm very, very good at estate and gift tax, and I know enough income tax to do these trusts. So there are some holes in my income tax planning game that I always have a CPA fill in when I do these. So my understanding, again, probably need to double check, but my understanding with an annuity, since you receive it as ordinary income, there's technically never any capital gains tax liability. So this wouldn't be of help to that. You're getting ordinary income tax liability. Yeah.
We got a lot of great questions. That was a great question. Thank you so much, Fred.
Just one thing related to that, for depreciable assets, the depreciation deduction does generally offset ordinary income, but that's different than what we're talking about here.
Okay. I guess Candace wanted to know, did the mother own the property? I don't know whether she meant the property that the Utah farmer had or.
You put the property in a trust, it's actually never technically owned by the relative.
Cool.
It's put in a trust and it's protected from creditors. But we're going to go over the mechanics of this trust in the next couple slides.
Okay, and I have time for one more, and then we'll get back to the rest of these. And if you did ask a question and we don't get to it, just go ahead and type it in and Ryan will get back to you on it. This one's from Madison. When the title holder of the property dies, don't I get the stepped up basis anyway? What's the difference?
Okay, so we're going to go over that in the next slide, but just real quick.
Good.
Normally what happens if you have an elderly, if you have a person that owns property and they die, then the heir gets a step up. Whoever inherits that property gets it stepped up. What we're talking about though, is we're talking about your property and then your relative dies and your property gets stepped up. We're not talking about your relative's property getting stepped up when they die, which happens automatically. We're talking about your property getting stepped up when they die, which you need to do this type of specialized planning to get that benefit. This is about you getting tax benefits when someone else passes away for your assets while you're still alive, not your heirs getting the step up when you die.
Perfect. Okay, so now we're going to get into the mechanics of this. So everybody, thanks for hanging on with us this long. I know it's a little technical, but this could really be big for some of you. So take notes, and Ryan's going to tell you about the statutory, this is so nice, the statutory underpinnings of OBIT. It's hopefully your eyes won't glaze over, but these are important things because this is going to answer Fred's other question. I think, are there any IRS PLR that this is legal and not subject to audit? And Ryan's going to talk about that. So let's go.
Yeah, now there is one IRS PLR. It's about the second paragraph that's that says this power of appointment that I'm about to talk about, that there may be a 1-year waiting period in some instances, and I'll get into that in just a moment. So this actually segues really nicely based on our last question. Internal Revenue Code Section 1014A1. A lot of, every estate planner and most CPAs know about this. Again, when someone dies, their assets receive a step up. So whoever receives that asset as an heir gets it, and they can then sell it, and capital gains tax eliminated on that asset. So that happens automatically for anything in your estate when you die. But buried further down in this section, this is second paragraph, Internal Revenue Code Section 1014B9. It says, if your trust grants a general power of appointment to someone, which would cause inclusion of the trust asset in their gross estate, it doesn't mean that asset is owned by them. It means that when they die, the asset in your trust is used to calculate to see whether or not they have a state tax liability. But if you do that, then the code explicitly says, even if they never use this power, I'm going to explain this power in a moment, but if they never use this power, they're just given it, they never use it, the asset stays in the trust the entire time, then when they pass away, the assets in trust get a step up as if they own those assets, and we get a step up under the first paragraph, 1014A1. So it's a way, you put your assets in a trust, you give a power to a relative, the relative never uses the power, they pass away, your assets get stepped up by giving them this power. And so that is the, that's kind of the linchpin there for this type of planning. Now, there's all sorts of ands, ifs, or buts. I'm gonna go over some of them. The ands, ifs, or buts can almost always be addressed by doing proper planning, by the way. But really, this presentation, like I said, I try and make it as simple as I can, but this is very sophisticated niche planning. So if you're seriously looking at this, it's going to be, you talk to me, we answer some questions, we then retain the attorney, we do a plan design for you, we make sure you know all the ands, ifs, or buts, and then we do the planning. So it's actually, a bit of a process. This will just whet your appetite, so to speak. So what is a general power of appointment? Go back to the last slide, please, Tammy. Wasn't quite done.
Okay, well, you can keep it on this one because
All right. So a general power of appointment is you form a trust and you give someone a power, and it can be a very broad power or it can be a very restricted power, but someone has a power to give trust assets to one or more people, and it could only be certain trust assets. The actual language we use in the trust has a complicated formula. So you can take your assets, put them in a trust. It will be an irrevocable trust, and that trust contains some language saying that my 82-year-old uncle Bob has power in his will only upon his death to give assets to, for example, unsecured creditors, subject to veto of a trust protector. So the real art of this type of planning is to draft the power of appointment in a way so that it will be seen as a valid power of appointment and not challenged by the IRS as not being valid. But we also draft it in a way so that the power can't be abused to take the trust assets away from you. And so it requires a degree of skill to do it correctly. And I can get much more into detail or give you articles on the give you a document that explains all the ands, ifs, or buts. I won't go into all of it now, but suffice it to say that we draft the power so it won't be abused. If the power is drafted too broadly, where your uncle can just give trust property to anyone at any time, then of course you can have an evil nephew or niece whisper in their ear, and then when they die, the property goes to them because they abuse the power. So you got to draft this power correctly so that that will never happen. But it's absolutely doable to draft it correctly. So we use what's called a testamentary general power of appointment. That means it's only exercised in the person's will or codicil or similar document upon their death. It's not going to go to them for their benefit. It won't go to any relatives. But they may have a power, for example, to give it to certain unsecured creditors, something like that. And it can be subject to a trust protector who is an individual who has a right to veto the exercise of that power. And if you want, you can even hire a professional protector. I can put you in touch with, someone along those lines. And then let's go to the next slide, Tammy. So again, if this clause in this trust is drafted too broadly, it can be abused. But if you draft it in a way so that there's really no chance that this power would ever be used, the IRS could challenge it as a sham. And talking about that PLR, again, there is one IRS PLR. There's actually more court cases. The court cases are much more favorable to the taxpayer than the IRS regarding these powers of appointment. I am going to talk about some things you need to do to make sure that this power will be seen as valid and not a sham. The IRS has said in a PLR, and again, PLRs don't apply across the board. They apply to that set of facts and circumstances, but people look at PLRs to kind of say, well, this will give us an idea how the IRS will view other things, but it's no guarantee. It's guidance, but only applies to that one case specifically. So there are some types of trusts where the elderly person or friend or whoever needs to live at least a year. And if you don't, then based on the PLR and also a section of the Internal Revenue Code, section 1014E, if they don't live at least a year, you won't get the step up. But there are other trusts where you'll get the step up even if they die the next day after you set it up. For this to be a valid power, if you give this power to some homeless guy, stranger you just met off the street, don't come crying to me if the IRS challenges that and now you're in litigation. Technically, that follows the letter of the law, giving a power of appointment to some total stranger. But if it smells fishy, it's good chance it's going to get challenged and maybe even, it gets deemed a sham. These statutes are tied to estate planning. So you want to give this power to people that would fit in an estate plan context, such as a close friend or a relative. I know one person that had a housekeeper that lived at their place and worked, and was her housekeeper for 20 years. Well, that's a good person to use when that housekeeper passes away. It fits in an estate plan because this client genuinely wanted to make sure that this housekeeper and her family were taken care of. Same thing with relatives. A lot of people will have, you know, mother or father, aunt, uncle, cousin, something like that, where maybe you have a desire to help with their burial expenses or some, you know, nursing home expenses, something like that. Those people are all good candidates for using with this trust. But, you know, again, if you just find someone off the street, it's going to look suspicious. So we try and use people where it looks like a normal estate plan. Whoever you give this power to, and again, whoever has this power of appointment, when they die, you get the step up. So can you go back? I was almost done. Tammy? Okay, never mind. So moving forward, oh, there we go. Okay, I appreciate that. For this, there is case law on powers of appointment, what are valid and what are not. And that's what we need to focus on. If you give a power of appointment to someone and they have no beneficial interest in the trust whatsoever, that's called a naked power, and it may be challenged. So best practice is to grant at least a small but meaningful benefit to the power holder. And I recommend you make some type of at least a token distribution from the trust to benefit this person, whoever the power holder is. You know, it could be $1,000 or $2,000 to help with their prescription medication. It could be helping with burial expenses. It is very, very, very difficult for the IRS to say this power of appointment is a sham if you actually exercise it to, you know, pay $5,000 or $10,000 of burial expenses from by using this power of appointment. They can't say it was a sham if it was used. And the amount of assets that are stepped up are any assets that could be subject to the power. So even if you only exercise this power of appointment when the elderly person dies, or, you know, it could be a younger, just whoever it is who passes away. It could be someone with terminal cancer, you know, who's in their 20s, for example. But if they actually use the power of appointment to pay off some of their, you know, burial expenses or credit card debt, you've used the power. So it's really, really difficult for the IRS to say it's a sham if the power is actually used. Okay, next slide, please. Okay, so different types of OBITs. Again, OBIT is the broad term, and then there's a bunch of different types of OBITs. So they're always irrevocable, meaning when you put the asset in the trust, you don't have a right to unilaterally demand that asset back. You can give what's called a limited power of appointment to someone. Could even be a spouse or, you know, close relative, someone you trust. And this type of power is different from the one we were just talking about. And this limited power, they can use that to get assets back to you if you need assets back out of the trust. But if you put assets in a trust, you do not have the unilateral right to get them back out. Someone else would have to, you know, consent to that. Transfers to trust, there's 3 different types of trusts we use. The first is you do a completed gift. I don't do a whole lot of these. A completed gift means you've made a taxable gift. Now, you don't have to pay actual tax on any gifts unless your lifetime gifts exceed, for 2019, 11.4 million. So it's very, very unlikely, unless you make a very, very large gift, that you'll ever pay any gift taxes. But you still have to file a return with the IRS. Some property needs to be appraised. If you have a stock, you are, you know, the day you transfer your stocks and bonds, you know, publicly traded stocks into this trust, you already know the fair market price. You know, it's listed on the market. But if you have real estate or something, we need to peg down its fair market value with a completed gift or a sale. So you may need to spend a few $1,000s, and if you have a lot of assets, to be more than a few $1,000s appraising these assets. That's completed gift trust. And
Hello. I think we lost Ryan here for just a second.
what that means is you've transferred the asset to the trust. Hello, can you hear me?
Yeah, you're just cutting in and out.
Hi, Tammy.
So, Yeah, you're cutting
Hello?
in and out. Hello?
Okay.
Gotcha.
Is this better now?
Yeah,
Okay.
I think you just cut out
So,
for a minute.
and I think we're near, I think this is the last or second to last slide because I know we're near the end of time. Incomplete gift trust means you don't have to file a gift tax return. You have not made a taxable gift. Yes, you have transferred assets to the trust, but it's you've had certain strings attached to that transfer so that you're not going to have to appraise assets or do a gift tax return. Anytime an elderly person dies, you're going to have to appraise assets to realize what the step up is too. But the initial transfer, you don't have to appraise with an incomplete gift trust. You know, again, we kind of analyze your circumstances to see what's best. The incomplete gift trust is the least expensive, but it's not appropriate for everyone for a variety of reasons. But for some people, it works great. A lot of married couples can do, if you're a married couple, you may be able to do an incomplete gift trust. It's a good fit for those married individuals. It just depends. The final one is you sell your assets to a trust, and you sell to a trust called OBIT It. You're actually a beneficiary of this trust. And this is the most costly to implement, but it is also, this type of trust is where you get around that 1-year rule. We were talking previously about if you have an elderly relative die within a year of setting up the trust, you may not get the tax savings. Well, this is the next section we're talking about. If you sell assets to a trust, they can die the next day and you're all good. If you do an incomplete gifts trust, then it's not 100% this will work. And so if you think the relative will die in a year or less, you don't want to do an incomplete gift trust. A completed gift trust does work, but you can't get the asset back. However, you can sell the asset or you can get back the income from the asset at any time. And for most people, that's all they care about is, you know, if you don't have the real estate in your name, as long as you're getting the rental income, or if you sell it and get the cash back, you're good to go. And so for those people, complete a gift trust is fine. And if you do a sell, that tends to provide the most benefits and gets around that 1-year rule with no strings attached or no limitations. But again, that's the most complicated to set up. And I'm not sure if there's one more slide or, oh, FAQ. Okay, well, I'll go through these quickly. Go ahead, Tammy.
Okay, and then we have just 2 more questions, and then thank you guys for being
Yeah,
on
that's
today.
all the hard stuff. Now we get to the easy stuff.
Okay, I'm going to ask this.
Go ahead, ask the questions. I'm
This
happy
is
to.
the first thing I thought of when you broached the subject with me. If this is so
Okay.
great, Ryan, why aren't there more CPAs, tax planners, and estate planners, and enrolled agents and financial advisors using it? Why is it so little known?
Okay, so there are other professionals who do this, but there are not very many at all. And the reason for it is there tend to be 2 different camps of tax planning. The camp that most people are in is income tax planning. And then the second camp of planners is estate and gift tax planning. You actually need specialized expertise in both fields. And there are very few planners that have specialized expertise in both fields in order to do this. This is high end, this is sophisticated. I know one attorney who does these in California. He can do them on his own. He doesn't need my help. There's a couple other attorneys you can find online that do this particular. This is upstream optimal basis increased planning. I work with 2 attorneys that do it, but they can't do it without me because they have gaps in their knowledge. They need my skill to do this properly. And I have a CPA where I need to bounce some stuff off of him, but he needs me, he can't set this up. So when I do this planning, I always involve, you know, I have an attorney supervise, and 95% of the time I have a CPA to sign off on everything too. So it's kind of a team approach, even, you know, even with me. And yeah, you know, 95% of the time, could I do these without a CPA or attorney? Do I have that knowledge base? Yes, but I don't want to take that 5% risk of making a little income tax mistake for your everyone's situation and state laws are different. So we do a team approach, and it's very specialized. It is catching on though. There are more and more people starting to do it, but your average attorney or CPA will never do this because it's too high end.
Well, here in California, and I don't know if everybody knows that I forgot to say in the beginning that I'm broadcasting out of lovely Southern California. There's probably a lot of people that fit into this that you would not think of as rich. So these could be good solutions for those. But that being said, how come you don't hear about this though, like on these TV talk shows and these financial planning shows and these podcasts? Is it just the IRS doesn't
too specialized, yeah.
too specialized, too technical,
Well,
right?
yeah, and the benefits used to be a lot lower because the amount of property you can step up is limited by the person you give that power of appointment to. It's limited by what's called their unused estate tax exemption. Now, it used to be, if you go back 10 years, I think it was about a $2.5 million exemption, meaning if they were worth $500,000, their net worth when they died, you could step up $2 million of property. Well, now, if they're worth $500,000, you can step up almost $11 million in property. So the benefits have become much greater just once the Trump tax plan passed. The benefits are now much greater. So now more focus is being put on this, but with high-end planning, most will never learn this, and the ones that do, sometimes it takes a while for them to catch on.
It's good. Well, I mean, now here's the question everybody's asking. Okay, this is so specialized. This is like hiring a specialist, in the medical field. How much is something going to cost? And we know that these are approximates because these are obviously customized. I mean, they're not one and done. They're not as you can't go to Zoom or any of those other legal sites and get this done. This is specialized. So what are we looking at cost-wise, Ryan?
Very good question. So starts at $15,000. It does depend on the type of trust you use and the type of assets you have. $15,000, if we did say the incomplete gifts trust, that would include my fee and the attorney's fee. But again, there are many instances where you'll just have to do more planning than that. I would say typical is $15,000 to $35,000. If someone comes to me, I had one person where they were worth $50 million. The budget was $200,000, but it was a combined estate tax savings and capital gains optimization plan. So I think we were saving them around 10 million. So yeah, spending 200,000 to save 10 million, no big deal, And with this type of planning, I would say it's almost always 10 times tax savings what you spend in fees. So if you end up spending 25,000 on a plan, there, almost always at least 250,000 in tax savings. But I would say more typical is 20 or 30 times. So it just comes down to if you could buy a stock today for 25,000 and you knew that in 5 years or 10 years, or maybe even in a year, if the elderly person passes away in a year, if you knew that stock would become worth $500,000, 700, maybe $1 million, would you buy it? Would you spend that 25,000? And this, this includes, I always do incorporate asset protection and estate planning, robust planning into this. If you just want asset protection and estate planning only with no tax savings, then plan pricing for that, if you do a basic plan, it's around $3,000. Again, it really depends on what type of assets you have, what state you're in, all sorts of things. But we do all planning, asset protection, estate planning, those fees are lower. The next step is you can give me a call, 800-798-2008. It's probably best to shoot me an email, which can be Ryan, RYAN, at pfshield.com. And you see the website, my website on the bottom, pfshield.com contact. You can send me a message, email on the form there, or shoot me an email. If you just want more information, if you want to really dive deep into the law and regulations, just hit me up. I will happily send you articles I've written, and there's even a 237-page master treatise written by a very high-end attorney. I'll point you to what he's written, as in addition to what I've written. I've written much more on this as well.
Okay. Well, I mean, this, like you said, you can see how complicated this is, and we could literally do this for hours. I wish we could. We're right at the hour mark. We have time for just 2 more questions, maybe, unless they're too involved. Yeah, Byron gives you a suggestion. He said next time we could put a flow chart of the different scenarios. That would be helpful. Yes, it would. We should
It
do
might
that
be
next.
too complicated.
Oh yeah, because it'll be like
I,
it would be. It would look
so
like
when
a
someone
maze.
comes to me, I actually do a written report and I include that in the report
Okay,
specifically to
perfect.
them.
Perfect. The trustee of the trust is the power holder. Is that correct?
No, so the trustee takes legal title assets and manages them as a fiduciary. The power holder does not take legal title to those assets, but he has a power to distribute assets to a narrow class of potential distributees subject to veto by someone called a trust protector. Now, a trust protector could be a trustee or someone else. The power holder is never a trustee.
Do you see now why attorneys rule the world? Okay, now.
And yes, this is complicated, but if I save you $1 million in taxes, it's worth it. And
Oh my gosh, yes, yes.
we write everything out. We take the time to make sure you understand everything you need to know, because the last thing I want to do is do this, and then a year or 2 later, you come back and you say, oh, I didn't know about this little detail. I'm unhappy. We make sure you understand everything before you do it. With
Okay,
that
perfect.
said, if you have highly appreciated assets and an elderly relative, you're probably going to want to do this. I've had very, very happy clients who have done this.
Okay.
Yeah.
Todd Berg says, hi, Todd, my friend Todd. I haven't talked to him in forever. Hi, Todd. Excellent information. Can we leverage the OBITs in such a manner to create a client need where we can make additional money? He wants to know, are you going to be part of his virtual staff so he can draw in these wealthy clients as a financial advisor?
Anyone who's a paralegal or tax advisor or attorney, we will hire you out on part of the project. My attorney, the attorneys and CPAs I work under, they can't split their fees. I am not an attorney. I'm allowed to give a referral. But if you're not allowed to accept referrals, any type of tax planner or attorney, you're going to be in on the project and charging fees for that. If you're just getting paid to learn, hey, that's fine. You'll get paid to learn. And your client will be extremely happy because, like I said, bare minimum, when we do this, we're looking at saving at least 10 times what they spent in fees and taxes, and usually more.
And Byron says again that few people have $11 million tax problems. Do you want to tell him how many of these you did last year just for one of your referral partners?
Yeah, so I had one person referred me 9 clients, including themselves. And some of these clients, you know, again, if you have a net worth of $1 million, but it's all in rental properties, there's still a good chance you want to do this. If we do, you know, the lower net worth people tend to be lower in fees. So if it's a $15,000 plan and you have maybe 400,000 in gain, in unrealized gain that's wiped out, you know, that's 6-figure tax savings based on a $15,000 plan, but you also got your estate and asset protection plan. I have people all the time pay me $15,000 just for an asset protection and estate plan. So you're getting that plus the tax savings.
Yeah, what's in it for the financial advisors? Okay, since I work with you guys, is not only is it a new marketing tool, something new that you can offer, something you know no one else is talking about that you can throw out there, but also you will get, as Ryan said, we will find a way to get you compensation as well for doing your job well done. Let's see, we've got the trust is the title holder, not the trustee. The trustee controls the trust and does not own the assets in the trust.
Well,
That's from Jerry.
yeah. So for example, if let's say you have real estate in a trust, you would deed in California, you deed the real estate into the name of ABC Trust, Mr. John Doe Trustee. That's how it's titled. So technically the trustee does take legal title and the trust is a contract, but it's kind of viewed as the trust having title, because if you have a new trustee, then you know, you'll actually swap it out so the new trustee is the legal owner. It's kind of seen as the trust being the owner, but again, on a deed, it's going to list the trust and the trustee name on the deed. They won't record a deed if you don't put the trustee name on it. So
absolutely true. That much I know. And we're right at an hour, a little over an hour. I want to thank everybody for being here. I mean, this is really good stuff. Some of you will benefit right away. Some of you can see capital gains issues looming on the future. This is a way perhaps for some of you to get out of those. Also, those of you who are financial advisors and CPAs and stuff, if you don't want to take the hours and hours and hours of training that Ryan did to get this expertise, then you can just enlist Ryan as sort of your, as part of your team. And I think that would be excellent service to offer. And again, if you've got a client that wouldn't pay $15,000 to save $200,000, I think you might want to change clients, because you can't fix stupid, right? So anyway, we thank you all very much. We're going to send you a copy of Ryan's book. If you gave us a legitimate email, we will send that to you. So you'll be getting something from me in the mail in the next few days, which is the recording link and also Ryan's book in a PDF form and anything else you need. Some of you have asked for specific things, and I will let Ryan know, and then we'll go from there. So again, love the fact that you all were here. Thank you very much. Thank you to Teresa's people. You guys are smart already. And thanks to Ryan Fowler. Guys, have a great day and enjoy your wealth today and every day. Thanks a lot.
Thank you. Bye.